Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
Well, good morning and welcome to Money Matters with Greg. I'm Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm here locally in Valparaiso, Indiana, and we are proud to broadcast today on WVLP 103.1 FM, community radio. Been here for a number of years and very excited to be here. This Thursday morning, October 9th, early morning, and talking about the markets today. We're going to go over what's going on this morning, what's happened this past week. Obviously, we want to address the government shutdown and then also walk into third quarter earnings, see how things are looking in regards to the third quarter. So again, broadcasting on WVLP 103.1 and also on podcast, anywhere you pod. You can find us Apple, Spotify, and wherever. And then, of course, all of our socials at Farrell Wealth, FARRALLWEALTH. And would love to hear from you. If you have any questions and topics you'd like us to talk about, we talk about money on this show, and obviously shows Money Matters. And anything that has to do with money in your life, money does matter to you in your life and psychology as far as the money that you have invested, as well as really just your overall makeup. It just affects so many things in your life. So that's why we want to talk about some of the things that we can help you with as far as adding some value and some financial literacy on this show, and kind of just to fill you in on what's going on. Today, we're going to talk about the markets and investing in stocks and bonds, and just kind of fill you in on what's going on out there in the stock market, because we're at all-time highs again. So we've had a really good week. We've had a good September, and we've certainly had a chance to do some things here that are very, very positive in regards to the markets overall. All right, we broadcast the show at 1 o'clock on Thursdays and then replayed on Saturdays as well. So it is Thursday morning. So we are going real time here, as close as we can get, certainly here this Thursday morning, October 9th, as far as the markets go. At the open this morning, U.S. equity futures were pretty much barely moved, pretty much a flat line early this morning. And really, investors have sort of been waiting for kind of hunting for the next directional driver to move the markets. S&P 500 is up around 14% for the year, and it's had a great year. And this stalemate in Washington is completed now its first week, and it looks like nothing's pending. No reports of resolution for sure is in the works. Another batch of economic data was basically punted this morning because with the government shutdown, that data is not coming about. We're not going to see it. As far as corporate headlines, everything was pretty light. The U.S. approved several $1 billion worth of Nvidia chips to be exported, which was good news in the chip making space. And then early third quarter earnings and reports have kind of trickled in. You've got Pepsi reporting turnaround on their beverage unit, while Delta Airlines shares popped after popping a nice profit as well. Treasuries traded pretty much a little bit lower overall as far as bond goes. You're talking about Europe. European equities traded mixed. This last afternoon in London, and that really sort of put them towards new all-time highs, which is really good. Automakers acted as sort of the headwind for consumer discretionary against basically the news on Ferrari. Shares of Ferrari tumbled after management offered a sort of a slower earnings growth rate. French stocks traded higher, which was good, but the ongoing political jitters were still just. There's basically President Macron stated there's a new prime minister that will be named by Friday afternoon. So that's what the markets are watching in France. Asia, major Asia markets closed mostly higher overnight, and that lifted regional benchmarks really to the first gain in 3 sessions. Mainland China has led the gains overall as far as the first session following they have the Golden Week holidays that's going on there. With materials receiving a lift from Beijing's tighter export controls, while technology names help power gains as well. Elsewhere, Japan extended recent gains lifted by SoftBank's subsidiary chip, the Graph Core chip, and research as far as their facility plans. There was good news there, while the yen is really weakened, sparking debates about whether authorities may intervene. So we'll see about that. Taiwan was also advancing. South Korea remained closed for the holiday. As far as yesterday, Wednesday's recap, stocks were definitely caught a bid in the wake of Tuesday's slight drop that lifted the S&P above 6,750 and the NASDAQ above 23,000. Which are all near or around all-time highs. Technology shares led gains in response to Nvidia's CEO Jensen Huang his remarks. His remarks that demand for the chip makers Blackwell, the new chip maker Blackwell Semiconductors. Demand is certainly high, and Cisco announced a new chip on the network, likely rivaling that of Broadcom. So we'll see about that. That was all yesterday. Industrials also outperformed, while energy, financials, consumer staples, real estate all posted losses of around 0.5%. Federal Reserve meeting minutes were released Wednesday. It really pointed to a willingness to further lower rates this year, although inflation, tariff impacts, and were heavily discussed, as well as the government shutdown. I'm sure was mentioned as well. So that's really just the update. The Fed minutes that did come out is very important to talk about those because we always read through those and want to bring those to you as an audience. The Fed minutes really focus on tariffs. There was really no mention of shutdown risk, but obviously that was in the past. So we know that there has been a shutdown. It's been going on a week. We think that the shutdown uncertainties certainly increased the odds of a further easing this year as far as another cut. But there were lots of diverging views in the Fed minutes. Some even thought that there was merit in keeping rates unchanged at the meeting. So it's kind of all over the place as far as the Fed governors go. We'll see how this pans out here in the next month or so. With tariff impacts, really you kind of keep this upward pressure on inflation. In the near term, inflation is not likely to reach any sort of target until late 2027, which means these pressures are stickier and more persistent than anticipated several months ago, but still that doesn't mean that we won't see improvement in 2026. So we'll see. The dollar has stabilized since the last meeting, according to the committee members, and has returned to trading roughly in line with the fundamental macroeconomic drivers, which is nice. So that was mentioned, and that was positive. Foreign demand for U.S. assets remained resilient since the previous Fed meetings as well. And then Governor Miriam preferred a 50 basis point cut and dissented from everybody that was really prevailing from the decision to cut 25 basis points. Moran really believes that the weak labor market justifies his view of 50 basis points, and his argument is reasonable if you think about it. If you really believe the CBO's estimate of really long-run unemployment rate, so we'll see. But bottom line, for today, futures markets may turn out to be more accurate than the FOMC's collective projections overall because inflation has consistently declined here, and looks like it's going to be declining in 2026. So it's going to definitely come in, and investors really should expect two more cuts this year, with a pause in the January 2026 meeting. All right, so that's our update today, here Thursday, October 9th. On just exactly what the markets are doing and whatnot. This show's Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth, and we're broadcasting today on 103.1 FM WVLP locally here in Valparaiso, and then podcasting everywhere you pod. So hopefully you're able to find us and listen in. And if you have any questions, for sure, I always like to remind people, please just email me, greg@farrellwealth.com. Or any of our socials. You can certainly DM me on any of the socials out there. Twitter, Facebook, LinkedIn, and Instagram are the four that we're allowed to use through compliance. So wanting to move on here to third quarter earnings, talk about that. That's really important coming up here, and kind of give you a little bit of a preview and very little suspense. I have to say it's quiet. Which is shocking, but that's really nice to have, I guess, for sure, with not a lot of drama. We really believe that corporate America is going to follow up the second quarter, which was outstanding. The earnings season was very, very good, with another good one here in the third quarter. And really, that's going to support a resilient economy, tariff mitigation measures for sure, AI and artificial intelligence investment. And really, currency should offset any increasing tariffs as well. We'll see about that. But with much of the investors' sort of collective attention focused on the duration and the economic impact of the government shutdown, how to access the outlook of the U.S. economy is really sort of like it's really in the absence of government data. We rely on so many things to have government data, and without that, and then also much of the data this year has just been wonky as well. I can't really explain it in any other way than just saying it's been off and really not believable. There's been some multiple reports that you're just like, the revisions, the deductions, or the revised numbers have so often just been making the announced numbers just wrong. And so a lot of the responses and the response rates have gone down. So we talked about that in a previous podcast. It's very concerning because it's very difficult to trust the numbers that are coming out. And right now there are no numbers. So that'll be interesting to watch for sure, as we see what looks like it's going to be a very nice third quarter. So not expecting much of no suspense and no drama really in this quarter. Earnings season is usually predictable quarter to quarter in the absence of economic issues or inflection points. And it really just suggests that the second quarter was more of an inflection point than the third on tariffs, because obviously that all came about in April of 2025. And that really ramped up like in a meaningful way as companies, the visibility of tariffs and the cost really improved going into the third quarter. The effective tariff rate ended July at 9.7%. And that was up slightly from 9% at the end of June. And that was Bloomberg as far as the source goes. But We think another 3 to 5 points of tariffs will likely be added on the July levels to land at an overall rate of 12 to 14%. Um, we're going to realize we're going to sort of rely on the Supreme Court. It'll determine how quickly we get there, I guess. We'll see. But the nation's highest court is expected to rule on the legality of Trump administration's tariffs imposed under the International Economic Emergency Powers Act. Got to get that right within the next few months. So we'll see what happens with that. But with less suspense around tariffs, economic growth, that could really approach 3% for the third quarter and continue to surge with artificial intelligence investment. You're going to see that continue, and roughly a 5% drop in the average level of the U.S. dollar from the prior quarter. Corporate America really has an excellent opportunity to post another low teens earnings growth rate for the S&P 500, and the up 8% upside produced last quarter may be too much asked for, but a 5% beat seems like a pretty reasonable expectation here. One of the main things too that I want to be able to talk about is just this artificial intelligence capital investment that's going to remain this driver here into the third quarter. So the Magnificent Seven will again be a significant driver and has been all year in earnings growth in the first and second quarter of the year, and then now going into the third quarter. In fact, 70% of the 8% expected S&P 500 earnings growth reflected in analyst estimates is coming from the big six technology companies, the Magnificent Seven minus Tesla. And it's remarkable that companies this big can grow earnings at 40 to 50%, but several $100 billion in capital spending annually can do that for sure. So as soon as, as this group continues to dominate the earnings growth, and the rest of the companies are just following in behind. And this trend will likely continue through the year end, and it's certainly expected to narrow into 2026. But for now, it's keep on spending and keep on investing. And this earnings growth pop is still big right now, but it really just underpins sort of that large growth equities over large value counterparts conversation as far as the market goes and investors. But really this gap between the two is going to narrow, and we'd really expect the entire bull market to kind of broaden out overall, especially as fiscal stimulus provided by the Triple B, the One Big Beautiful Bill Act, and these are all positive views for financial fits, really, as far as the theme goes. We're seeing some really, really nice earnings and looking forward to a really positive quarter. I have to say, we're encouraged. As far as where are the tariffs right now and going into the third quarter, tariff effects were expected to show up in the second quarter, reported in July and August. And they certainly showed up for some global industries such as automakers and industrial equipment makers, apparel retailers for sure. But on the macro level, the effects have really been much less than we have really seen or certainly anticipated. And there have been lots of reasons for this. Some of the tariffs that haven't even gone into effect yet. That makes sense. Some service industries are largely unaffected by this. As much as you see that everyone's affected by, in the media, that's just not true. And so AI-driven productivity enhancements are really starting to show up too, supporting the profit margins, while most AI companies have sort of moderate tariff exposure. So we've really seen, and then we've also seen a number of deals side deals committing to investing in the U.S. That really are furthering the Trump administration's objectives as far as Apple, Intel, Pfizer, Taiwan Semiconductor are all among the big names that have done something. And most imports from Canada and Mexico are subject to lower tariffs under the trade agreement, the USMCA trade agreement. So that's been another, sort of uh, something to consider, but didn't know that sort of stuff. That's what we try to bring here, is bring some information to you probably don't really hear out there. Um, and then the other thing, that tariff costs have really been spread out among exporters, importers, consumers, and kind of reduces the hit to profit margins. So there's more margin pressure with tariffs, obviously, and it's likely coming. More of these tariffs sort of flow through in the next months. So we'll see how this goes. But based on Wall Street, and Wall Street's really not worried about Main Street right now. The corporate America sort of expectations are that margins will continue to expand. And given the recent track record, we don't want to bet against corporate America in any way, expanding margins through, whether we just don't expect quite as much expansion to be reflected in these sort of consensus estimates out there. I'm not betting against corporate America, and I hope you're not either, because you really have reasons for optimism going in here to the third quarter. And we really expect corporate America to benefit from steady economic growth next year, supporting solid earnings growth overall. I always say, even though valuations are high right now, and there's and the valuation of the stock market and a number of things are priced in, and they certainly are not cheap. Earnings are justifying such, and fiscal stimulus from the OBBBA is expected to really jumpstart growth in late 2025. And obviously we have interest rate cuts coming. We expect companies to manage their tariffs effectively. The dollars going to AI investment really are surging, and it's only going to get bigger next year. These are going to drive strong technology sector earnings gains and still continue to be the leader. And another year means companies will have more time to generate productivity gains from AI, supporting all those margins. So the recent increase in earnings estimates is really encouraging. And then don't forget, one thing that we always seem to not mention is share buybacks. Those are expected to maintain or exceed at a record pace, which helps depress the denominator in the earnings per share, the EPS calculation, and lifting the earnings per share, or the EPS. So that really helps. So pull it all together. A 10% increase in S&P 500 profits in 2026 is a real possibility. That puts $290 per share in play for the index of earnings per share next year, compared to 280 plus range. You really just was mentioned by a lot of analysts just last quarter. So really positive things. We're feeling really good about where we are in regards to the markets and in regards to corporate earnings. So feeling really good about all that. Just wanted to be able to mention it here on this show. All right. So again, it's Greg Farrell, CEO and president of Farrell Wealth. The show's Money Matters with Greg on 103.1 FM WVLP here locally in Valparaiso, and then podcasting wherever you pod. We're excited to bring together, let's see, it's episode 169 here. And you can find us on Spotify and Apple and anywhere else you pod. I hope today was helpful for you to kind of update you on the markets. We're looking forward to having a number of guests coming on here in the in October and November coming up here. So looking forward to addressing anything you want to talk about, financial literacy and anything to do with money. Just let me know. Email me, greg@farrellwealth.com, and hope you have a very healthy and profitable week. Go Cubs, go Hoosiers, It's a big week for both. And certainly we'll talk to you next week. See ya. Bye.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.